Howdy, this is David Groce, your Texas Tax and Lawman. Welcome back to our real estate series, Big Hat, Big Cattle. Today, let's talk about paying taxes on the sale of your real estate. Yes, you pay income taxes on your rental income as you receive it, but the IRS also wants more money out of you when you sell the property. They call this a tax on a capital gain. So what is a capital gain? A capital gain occurs when the sales price of a capital asset, one purchased and held for investment, exceeds the price you paid for the property. If you buy a property for $100,000 and then sell it for $125,000, you have a gain of $25,000. While that is a good, simple explanation, calculating a capital gain is really a little more complicated. The technical calculation is sales price minus cost of sale minus basis. In this formula, we need to define two more terms, cost of sale and basis. Cost of sale means it includes the closing costs, the title policy, the realtor fees, and the other expenses you pay at closing that reduce the amount you receive. This does not include paying off the note on the property. Basis is the price you pay for the building plus improvements. Let's look at your hypothetical sale again. We buy a house for $100,000. We spend $10,000 rehabbing the house and then sell it for $125,000. At closing, we pay closing costs of $5,000. Therefore, your net gain, your capital gain, is $10,000. Once we know the capital gain, we can apply the appropriate tax rate. Keep this thought in mind. Capital investment should be purchased for long-term investing. You're trying to build for the future. Thus, the IRS has two different tax rates it applies to your capital gain: short-term and long-term rates. Short-term capital gains taxes are the same as your ordinary tax rates and range from 10% to 37%. Short-term rates apply to sale of assets that you hold for 1 year or less. Long-term rates are either 0, 15, or 20%, depending on your regular income tax bracket. To get the long-term rate, you have to own the property for 1 year in 1 day or more. On top of the capital gains tax, you'll probably pay the net investment tax of 3.8%, which is the Obamacare tax added to investors. That tax continues to linger even today, and I can't wait until Congress finds the courage to kill it. As a tax lawyer, clients regularly ask me if there are any exceptions or loopholes that can get us out of paying capital gains tax. Well, to that question, I simply smile and answer, I'm so glad you asked. We currently have 3 ways to defer or avoid altogether the capital gains tax. First, we have the sale of a principal residence exclusion, which I have referenced several times before in prior videos. The law currently provides that if you purchase a principal residence and live in the house as your primary residence for 2 out of a 5-year period, you can exclude gain on the sale of up to $250,000 per person. This means a husband and wife could buy a house for $500,000, live in it for 2 years or more, and then sell it for $1 million and pay 0 tax on a capital gain of $500,000. This is a terrific tax provision for those willing to move every few years. Second, we have the like-kind exchange rules under Internal Revenue Code Section 1031, which provides that you can roll over the proceeds from the sale of real estate into another real estate property and pay no tax. Now, let's assume you have a warehouse. You bought it for $250,000. You sell it for $500,000 and you roll all of the $500,000 into the purchase price of the new $500,000 warehouse. If you do the like-kind exchange right, using a qualified intermediary, you pay no tax on the $250,000 capital gain and actually defer any tax due until you sell the second building, which leads us to our third exemption, the step-up in basis. This is a helpful capital gains rule which says that when you die and your property passes to your kids, they get a step up in basis. That sounds like tax mumbo jumbo, so let me unpack it for you. If you buy a rent house for $50,000, then you give it to your kids 20 years later when you are still alive, the kids receive the house and they receive your basis, the $50,000 you paid in the property. If they then decide to sell the house and it's worth $120,000, they would pay capital gains tax on $70,000. Remember, sales price minus basis. However, if you hold the house in a living trust or in your personal name and it transfers to the kids at your death, the kids get a step up in basis. This rule says that their basis becomes the fair market value as of the date of death or the alternate valuation date. If the value when you die is $120, then the kids get a basis of $120. They then turn and sell the house for $120. They would pay no capital gains tax because the sales price minus the stepped up basis equals 0. And any tax rate times 0 is 0. Now, imagine you combine those rules and did a like-kind exchange from one property to another and then hold that last property until you're passing. You wouldn't pay tax on the sale of the first property, and your kids could sell the last property and pay 0 capital gain. That's a pretty exciting thought, and we help our clients do it regularly. Hey, thanks for tuning in. I hope this tax talk helps you grow as a business owner and real estate investor. If so, click like and subscribe below. Make sure to forward to a friend as well. Until next time, adios. Texas Tax and Lawman Legal Disclaimer. Hey, I'm a lawyer. You know I have to have some lawyer mumbo jumbo. This is a general information video, not client attorney privilege information. The content is informational only and is not directed to any specific facts or circumstances and cannot be relied upon as a legal opinion, even though that would be nice and save you a trip to the lawyer. If you have a specific legal question, feel free to contact David Groce directly or seek qualified legal or tax counsel in your state of residence, state of mind, or whatever place you call home.